Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Thursday morning, February 18th. I'm actually pre-recording this, but just a couple of hours before real time. So pretty close. We'll see. But futures right now, a little weak. So I assume we're going to probably open a little weaker on the session. Last time I looked, Dow futures down about 90 points, S&P 15, NASDAQ about 96, almost 100 points on the NASDAQ. So NASDAQ for the second day in a row looks like it's probably going to be hit a little bit harder. I think some of this has to do with options. It is option expiration week. Options expire tomorrow. And the history of the stock market is such that you do need to be careful as you go into option expiration Friday and even into the next week, because many of those options get exercised. And then market makers are simply on the other side of those trades. So it's no different, really, than being on the other side of options trades. We're going to get all into that in just a little bit. I do want to just quickly go through the agenda with you for today. I'm going to go through the daily market recap. Then we're going to take a look at the talking technically. I always like to get into talking technically. I got a couple ratios I want to show you there today. Then we'll jump into Max Payne. I'm going to look at the technology sector and look at that sector summary. Just wanted to point out a couple things there. Then we'll get into earnings spotlight, and we'll wrap up today with 3 must-see. So let's get into all that. But first, let me take you over to earningsbeats.com. Just want to point out, if you're not already familiar with Earnings Beats, we do have a free newsletter. Love to have you join. Simply enter your name and email address, and we will get you our Earnings Beats Digest newsletter out every Monday, Wednesday, and Friday. Normally is delivered before the market opens. It's very brief, usually just taking a look at one stock, one opportunity. From a relative strength standpoint, sometimes talking about upcoming earnings, a company that's getting ready to report, maybe taking a look to see what the charts are telling us, that sort of thing. So we'd love to have you join. It is completely free, no credit card required, and you can unsubscribe at any time. We also do things for our Earnings Beats community, and if you're part of that newsletter, you're part of our community. For instance, tomorrow, Friday, February 19th, Julius DeKempenaar, creator of the RRG charts and a good friend of mine, will be joining me at 10 a.m. on Friday, and we're going to talk a little bit about the market rotation that's taking place. We're going to evaluate it. Got some really cool stuff. I think you would really enjoy. Julius is planning to talk a little bit about some of the global markets and how they compare to the U.S. market. Also, he's looking at the cryptos. He's done some fantastic work on the cryptos. I think you'll enjoy taking a look at a couple of cryptos that are doing better than Bitcoin. Don't know if you're familiar, but anyway, Julius is going to be joining me tomorrow. We should have a lively discussion. We always do, and that'll start at 10 a.m. But you need to be part of our community in order to access the room. We'll send out room instructions to our entire Earnings Beats community, both the free newsletter and our paid subscribers. That'll go out in the morning on Friday. So again, if you want to attend that or even just get the recording, we record all of our events. So if you can't make the event, we'll make sure you get a copy of the recording and you can still check that out. But simply type in your name, email address, and hit subscribe. All right, let's take a look at the action on Wednesday. The Dow Jones finished up 90. S&P was down 1, NASDAQ down 82. So you could kind of see the bifurcated action there. Large conglomerates on the Dow did well. S&P 500, very diversified. Kind of middle of the road, down just a point. And then you've got your high tech, that tech-laden NASDAQ, which was down 82 points. I'm going to talk about technology a little bit. I think a lot of that had to do with options. And I think that's what's going on with futures again this morning. I think there's a lot of manipulation that takes place around options expiration you need to be aware of. Mid caps down about 0.5%, small cap, same thing. Leading the charge, energy up 1.5%. Energy's made the breakout now above 45, taking out the June high that we saw back several months ago. So this is good news, not just for energy, but for the market. A bull market, a secular bull market, which is what I've been talking about for a long time. Essentially, it's a rising tide lifts all boats kind of thing. And eventually we expect energy to break out. We expect utilities to break out. Of course, we're going to be looking for technology and discretionary stocks and so forth to do well down the road. But you see the list here. Energy did well. There's your discretionary move off the 20-day moving average. Financials making the breakout. If you haven't been noticing, 10-year Treasury yield, I'll pull that chart up for you in just a second. 10-year Treasury yield rising. That's good news for financials, and we're seeing that reflected in the chart. Technology was the weak link. Well, there's a lot of technology companies that are heavily traded in the options world, and I think that was a lot of what's going on. I wrote an article about it last month. Um, I think it was something along the lines of, this is how market makers steal from us, or something like that. But you should go check that article out, because this happened last month, and almost identical, maybe to a lesser degree yesterday, but very similar. Technology taking the hit yesterday, and I have a feeling they'll probably take another hit today. Renewable energy, one of the best areas of the market, down 5% as we head toward option expiration. Not a shocker. This is what we see month after month. If you understand Max Payne and you follow options expiration, there's a lot of manipulation, a lot of games played in the short term. If you're a long-term investor, it means nothing. Simply yawn, go about your business, and you'll be fine. Short-term traders, though, you can have a lot of gains pulled right out from under you, especially if you're trading some of these high-octane stocks that are very actively traded in the options world. All right, let's keep moving. 10-year Treasury yield. So yesterday we had just a plethora of economic data, and it's going to continue a little bit this morning. January housing starts due out. In December, we saw 1,669,000 units. We're expecting to see that drop just a tad to 1,655,000 units. January building permits. December was a little bit over 1.7 million units. We're looking for 1.67 million units for January. So we're looking for a little drop in building permits as well. Initial jobless claims last week was 793,000. We're looking for that to drop to 768,000. And then February Philadelphia Fed Manufacturing Index, the estimate is 20, and January was 26.5. So we're looking for that to drop a little bit. A little theme going on this morning. We're expecting a lot of things to drop, especially the overall market based on futures. All right, looking at this chart, though, here is the 10-year Treasury yield. So we've got this move the last 4 days from 1.13% up to 130. That's a pretty good move in Treasury. That's a lot of money that is coming out of the bond market, and it's finding its way into stocks. I mean, it may not be finding its way into technology stocks right now because of options, but it will eventually, in my opinion. Right now, it's finding its way into the equity markets, though. We saw the Dow up yesterday. We've seen the market, equity market overall, doing very well, hovering up near all-time highs. And I expect we're going to see more of the same going down the road. But short term, again, we do have options to contend with. In the meantime, though, this rising yield is helping areas like financials that underperformed for quite a while. And that area is beginning to show some nice leadership. And if the yield stays up, I expect that leadership to continue in the financial area. All right, let's move on. Now I want to talk a little bit about, in talking technically, I want to talk a little bit about a couple of key ratios that I follow. So one ratio that I follow, and this is really my staple. I mean, this is my go-to. I don't know that there's a better ratio to follow. I wouldn't do it day to day. I mean, day to day is going to send you all kinds of mixed signals, because I want to see this ratio go higher, but I want to see it go higher over time. I just want to see a pattern of higher highs and higher lows is essentially what I'm looking for. If we start going through a couple of years of bull market and all of a sudden you see this ratio going down for a couple of years, that's a problem. That's a warning sign to me. So, if we go down for a couple of weeks, I'm not worried about that. Once we had the move back 2013, 2014, I don't know if you recall, this was a really strong move in the stock market. The S&P 500 had a huge move from the middle of 2012 to early 2014. And you can see this ratio, consumer discretionary versus consumer staples, moving higher. That is a confirming sign of a bull market. But look what happened in 2014. It went down for 9 months, came back up, kind of tested up here, went back down, actually broke down temporarily. That actually had me a little nervous about the market. I remember becoming much more bearish at the beginning of 2016 because of this. But it rallied right back up and it held and then started working its way back up. If you recall, late 2016 at the time of the election, all the way through the early part of 2018, the S&P 500 was flying. And look at what the XLY XLP was doing. It was breaking out to new highs. So eventually when we got into the trade war and we struggled a bit, we were still overall in an uptrend here. And when we broke down in March and April, I mean, obviously the pandemic, there was a quick rush out of consumer discretionary, but look at the move back. I mean, by May or June, I mean, we were back up near highs, even though we were in the midst of the pandemic. So that was one of the signs that was telling me this isn't a bear market. This is a bull market. And you can see what's happened since. So when I look at the market and, you know, there's a lot of folks, write to me and say, well, isn't this giving you heartache? Isn't this going to be a problem going forward? Isn't this, well, one of the things I always point to is, I recognize that the folks on Wall Street, they're MBAs, Goldman Sachs of the world, they hire a bunch of MBAs and so forth. Those folks are smarter than me. I'll admit it. They're smarter than me, and they're putting their money into consumer discretionary stocks. There's a reason for it. And again, when you look down here at the bottom, this is the correlation between the direction of this ratio and the direction of the S&P 500. It's almost always in positive territory. We have a few times where, we go opposite, but for the most part, we are in, hand in hand. The ratio and the S&P tend to go hand in hand. And right now, we're sitting at 0.82, which is very positive correlation. And look at the XLY, XLP going up, S&P 500 setting new highs. Hard to get bearish with this ratio. The other ratio I want to show you is the Russell 1000 growth versus Russell 1000 value. And this is something that I'm following. Now, down at the bottom, the correlation, I'm running it against the NASDAQ 100, not the S&P 500, because the NASDAQ 100 houses many more growth stocks. And this is growth versus value. So when the growth number is going up, you would think that the NASDAQ also is going up. And this correlation somewhat proves it. I mean, it's obviously not perfect, but we spend a whole lot more time up here in positive territory, extremely positive territory. Last 4 or 5 years, we spent much of our time up here above 0.75. That's very strong positive correlation. But the point here with this chart is that it's telling us growth stocks have been crushing value stocks. Now, the last 5-6 months, not so much, but I think we're, when you get a stock that goes straight up and then it consolidates for 5 or 6 months, it gets frustrating, but it's not a bad thing. It builds a base from which it can launch again. I really believe that the growth versus value is building a base. I don't know how long it's going to build this base. I don't know how long we go sideways, but I do believe that we're going to break back out again. And the reason I believe we're going to break back out again is these earnings reports that I'm seeing coming out. The numbers from many of these growth stocks are phenomenal, the way that they are growing their earnings. Now, we're getting some of the value to play catch up. Some of the value stocks are starting to show some really good numbers as well, which is awesome. We should be embracing that. I'm not worried that value stocks are performing well. I want value stocks to perform well. But in a low interest rate environment, high growth, I mean, if valuations are truly favoring growth, which they should in a growing market and in a low interest rate environment, then I think this ratio eventually takes back off again to the upside. I don't think that this is the end. I don't think this is a parabolic GME, GameStop kind of a move. I think Wall Street is pouring their money into growth stocks. Take a look at this. Think about this for a second. Remember in March, everything falling apart? Why in the heck would growth stocks be going up relative to value stocks during a pandemic when we were supposedly heading for Great Depression 2.0, if you recall? Why would growth stocks be taking off during a pandemic? This was one chart. If you looked at this chart, you had to question everybody that was talking about a bear market. Growth stocks do not do well in a bear market. Growth stocks get crushed in a bear market. So while everyone's panicking, you got all the headlines going on around us, Wall Street was quietly accumulating growth stocks in a major way. And so I don't think this party is over. I think we're consolidating. This may continue for a little while, but I believe ultimately we break out again, and these growth stocks, assuming the economy strengthens, which I believe it's going to, I think that is going to favor growth stocks. They're going to grow more rapidly, and this ratio I think takes off again. We'll see. All right, let's move on. So I want to talk a little bit about Max Payne, and the best way to do that is to bring up the sector summary for technology. So this is actually the industry group summary under the technology sector. And the reason I want to pull this up, I had written the article back in, and I'm going to see if I can find that article, because it really is an article that you need to read if you're not familiar with options. So if you go into my blog at Trading Places, and it was in January, and it would have been sometime right around options expiration. There it is. This is how market makers steal from us. So January 16th, I want you to go in and take a look at this article, because this was the same thing I wrote about last month with Max Payne. But if you go down and you look at manipulation that's taking place, I mean, it was, and we're not done this week, this month. So we'll see what happens here over the next couple of days. But look at the sector leaderboard. This was in January as we were getting close to option expiration. The worst performers among sectors had the best scooter scores. The best performers had the lowest scooter scores. Industries. This was a look at the consumer discretionary sector. The best performers, you can see, had pretty low scooter scores. Now, as you go back down here at the bottom, look at all these. The ones that were down more than 2% or 3%, 99 automobiles, obviously very strong. But then look at all these other scooters, pretty high. And then you break down technology, which I'm getting ready to do for you again. Look at the group that had the biggest drop in January, renewable energy. Renewable energy, if you look at the chart, hasn't gone down much. But when you really need to be careful is when you get close to options expiration, because these companies, as they've been going up, they're being heavily traded options, a lot of calls being bought, and just a simple 2 or 3 day pullback can wipe out a ton of net call premium. Market makers, it's like it's raining money outside for market makers when they take short positions. So it's in their best interest for many of these stocks to go lower, and they will commit their capital from time to time. Well, they commit their capital all the time, but they will actively short. They're traders. And if a stock was trading at $11 and I told you that if the stock were to drop to 10, you would make a lot of money. You would want to do anything in your power to get that stock down from 11 to 10 to make that money. I mean, it's incentive for the market maker. So anyway, that's kind of the backdrop. Go back and take a look at that article and read through it. But now let's fast forward to yesterday. So yesterday, technology has a bad day. So, nobody really paying that much attention. Oh, well, profit taking, or, technology's too high, blah, blah, blah. But when you look at the breakdown of technology and what performed poorly yesterday, renewable energy, shocker, and semiconductors. Have you been watching the semiconductors go up and up and up and up and up every day? Yeah, a lot of those companies have options. They trade options, and many had very significant call premium, net call premium. Net, I'm saying the call premium is a lot more than the put premium. So that's why I say net call premium. And it behooves market makers to move prices lower. And so what are we seeing? Those groups, look at the high scooter, the 4 worst performers, 3 of them are the best 3 performers in technology. Electronic equipment's been on fire. Semiconductors on fire. Renewable energy on fire. I mean, this is manipulation at its finest, and it's legal. So as a trader, if you're a short-term trader, you need to be aware of option expiration week. The monthly options expire the 3rd Friday of every month. It's so important that we do a dedicated webinar to it every month at Earnings Beats. We just did one Tuesday night. We do it the Tuesday before options expire. And in addition to talking about, what could happen, we give stocks that could benefit. If a stock has been beaten up going into option expiration week, then there's probably a lot of net in the money put premium, meaning that market makers would have an interest of taking a stock higher. Well, Clorox was one of those stocks. Look at Clorox yesterday. Stock had been getting beaten up. There were so many puts. Wow, look at that miracle. Stock up 2.4%, $4. I calculated the max pain to be 197. I don't know if we get to 197, but I think there's a chance Clorox runs up, tests that 20-day moving average. Now, do I like Clorox? No. I'm sure market makers aren't particularly attracted to this chart either, but they are attracted to making a lot of money. Got to be careful. So anyhow, that's just one of the many. I mean, also it goes the other way. So let me show you Twitter, because Twitter has been on fire. But when we calculated it Tuesday, Twitter has max pain way below current price. Look at this move on Twitter. A month ago it was at 45, went up to 75. Yesterday, after we had our session Tuesday night, all of a sudden Twitter down 3%. Wow. Wonder what's going on. Everybody's, most folks that don't follow options probably are just like, a little profit taking. Yeah, market makers are doing some profit taking. They're taking your profits. I'm going to just see what Twitter's doing pre-market here. Down another 73 cents, another 1%. So this is where that legal thievery comes in. It's like you've been trading and you got your cash register drawer open, and market makers just coming in and just reaching in, taking it. That's what's going on right now. Anyhow, let's go ahead and move on. I want to move on into earnings spotlight. So there's still a lot of companies reporting, by the way, and some pretty good names, big names. Baidu came out, reported. They did beat on their bottom line, 308 versus 251. The stock is down a little more than 1% in pre-market. It's had a big run. It was down yesterday. I can guarantee you there's a lot of in-the-money calls here on Baidu. So would I be shocked to see this stock maybe test the 20-day? I wouldn't be shocked at all. In fact, it would make the market makers a lot of money. They'd be lining their pockets if this stock drops to the 20-day. So keep that in mind. Twilio reported. Twilio came in with 4-cent profit. They were expecting an 8-cent loss. So really good number there. Twilio easily beat revenues, $548 million versus $455 million. They did have mixed guidance, though. They guided their quarter-one revenues higher, but they guided their earnings lower. Seems like the market, however, is focusing on the positive. Twilio, TWLO, is up 9.5% pre-market. So after losing 2% yesterday, testing that 20-day moving average, it is going to look to break out today, and likely will, at least at the open. We'll see whether or not that holds. But the AD line here on this stock looks good. Relative strength, it's one of the better software stocks. So Twilio, to me, looks really good. I don't like that lowering of the EPS, but I would rather have a company beat its estimates. So it gave Wall Street its estimates 3 months ago, or, it's been updating them throughout the quarter, and they came out and they beat it. That's good. Under promise, over deliver. That is a recipe for success. Now they're lowering next quarter's guidance, which is fine. If you're going to give some bad news, lower expectations, because you want to under promise and then over deliver. So I would rather see a stock beat top and bottom line and then warn about the next quarter than to miss top and bottom line and say, yeah, but next quarter we're going to nail it. Well, you just over promised and under delivered in the last quarter. Why is next quarter going to be any different? Why should I believe you now? That's the approach. And I think that carries a lot of weight on Wall Street. I think they would, if I was an analyst, I would much rather a company tell me up front that, hey, things might be a little slower. And if you have a tendency to beat every quarter, I'm going to kind of take that with a grain of salt. I'm going to say, well, yeah, they're being conservative, which is good. I want them to be conservative. I don't want them to be outlandish and just throwing me numbers I want to hear. I want them to be a little conservative, so I have a little wiggle room that I believe they're going to come in and beat those numbers. Those types of companies, those types of managements make analysts look really good. You go the other direction, they make analysts look really silly. And analysts don't like that. I don't blame them. So Twilio, I think that's a good report, even though they did lower guidance. That's why, and I get this question sometimes, when we have a strong earnings chart list that we keep at Earnings Beats, and Twilio will be on it because they got a great looking chart. They're obviously liquid. That's another one of our criteria. They trade plenty of shares. That's not a problem. They've beaten their top and bottom line. And technically, everything looks good. Look at the relative strength. They're in a great area, software. Of course, they're going to be on the strong earnings chart list. But then members will write and I'll say, well, why would you consider Twilio? Do you know they lowered guidance? Well, this is my whole explanation. This is why I'm okay with lowering guidance. I don't care about lowering guidance. Sometimes the market will hit a company because they lower guidance. But if you got a good company that's been a great performer, relative performer, and they come out and they guide lower and the stock gaps down, many times that's a great opportunity to jump in, especially if they've got a long-term track record of beating estimates. All right, let me go over a couple more of these very quickly, a couple that had good numbers. Sleep Number, SNBR. Wow, big report here. So revenues, 568 million versus 555 million, easy beat top line. Bottom line, 219, expecting 153. This is how companies go higher, and this is why we're looking at a secular bull market and why prices are going to keep going up. Because Sleep Number is just blown their estimates out of the water. Now, future earnings are going to have to be adjusted. Future growth rates are going to have to be adjusted. And Sleep Number guided earnings per share higher in fiscal year 21. So, this was really a win-win-win. Look at the AD line. Awesome. Price action. Awesome. Furnishings moving up nicely. Everything across this chart. How could you not like Sleep Number? I see nothing wrong with this chart. Now, it's up 12% in pre-market. So it's going to be a breakout on the open. We'll see what happens after that. But I'd love to get this one on a pullback. I think Sleep Number looks good. One that's not faring so well, let's go with stamps.com, STMP. So Stamps, I saw the, let's see if I can pull it up here. Where was it? There it is. Yeah, I saw their bottom line. I didn't see revenues, but I did see bottom line, $4.13 versus $2.63. That's huge. But I didn't see guidance. I didn't see revenue. So I don't know what happened. Stock's down 9% in pre-market. Just goes to show you, it's hard to predict how the market is going to react. Use that to your advantage. Some folks see, Stamp down 9%. Maybe it's not going to be a good stock. Hasn't broken out. It's certainly not one of the better stocks that I've seen on a relative basis, but it was moving up a little bit. But, it's going to be down 9%. We'll see. All right, quickly, let's go through the 3 you must see. Wells Fargo. I just got to give a little shout out here to Wells Fargo. AD line turning up, breaking out to a multi-month high, and it's starting to show relative strength. Finally, Wells Fargo looking pretty good there. Next up, just wanted to point out Tractor Supply, TSCO, breaking out of all this consolidation. Look at the volume picking up. AD line looks good. I think Tractor Supply looks good. Finally, Expedia making another breakout yesterday with good volume. I've been talking about this one. AD line looks great. Travel and tourism is doing very well now. And Expedia is one of the leaders. So watch this one. All right, that's it for me. Everybody have a great rest of your Thursday. And I'll be back next week over at Earnings Beats on Monday for your next Trading Places Live. Take care, everybody. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.